Salad Shop Tax Roundup. We're covering things that have occurred during June 2017, and it's been a really busy month. Parliament's been busy. We've had quite a bit of legislation either introduced into Parliament or passing through Parliament. That includes locking in the $20,000 immediate deduction threshold for SBEs for another 12 months, which is great, but also changes to the foreign resident capital gains tax withholding rules, which can apply and capture lots of transactions now that maybe weren't captured prior to 1 July. The ATO has also been very busy, lots of tax rulings, lots of tax determinations. We're going to have a look in detail at a couple of those, particularly focusing on the ATO's updated guidance in the area of travel deductions, relevant to both individuals, so employees and sole traders, but also quite relevant to employers as well, who are looking to minimise their FBT obligations.
Before you get ready to submit those tax returns, it's a good time to think about depreciation on investment properties for your clients. People may have bought properties, they may have renovated properties, or they may have just not quite had done it properly in the past. There's some deductions there. We need to make sure we get these things ready before you look to submit those tax returns and get the maximum deductions for these clients.
In relation to legislation, as we know, for small business entities, the immediate deduction threshold for $20,000 was due to expire on the 30th of June 2017. However, in the May 2017 budget, they announced that would be extended for a further year to the 30th of June 2018. That legislation is now passed, so a small business entity that is planning ahead for the 2018 year can rely on access to the immediate deduction threshold of $20,000 instead of the reduced to $1,000.
Now, probably one of the big rulings that we've seen come out this month is TR 2017 D6. It's only in draft at this stage, but what it covers is the tax treatment of travel expenses both for individual taxpayers, but also looking at it from the point of view of employers who might be paying or reimbursing travel costs for their employees and are trying to use the otherwise deductible rule to minimise their FBT liability. Now, the ATO has basically tried to consolidate lots of the guidance in this area. So the ATO is or has withdrawn a number of older tax rulings and tax determinations dealing with the tax treatment of travel expenses, and has, I guess, attempted to consolidate a lot of that and modernise that guidance so that it's a little bit more applicable to modern day travel and working arrangements that people typically face. The ATO introduces some fairly new concepts in that ruling as well. So we've got concepts around special demand travel and also coexisting work locations. And what you'll find is, as you go through that ATO ruling and the examples that are provided, that there is a different approach that we may need to take now when we're looking at the tax treatment of travel expenses. For example, let's think of someone who might be based in Sydney 3 days a week for their job, but part of their work arrangements is that they have to travel to Melbourne and work in the Melbourne office for the other 2 days of the week, and that happens every single week. So it's an ongoing and regular pattern of working in those two offices. Now, some of the ATO guidance in the past would probably suggest that travel to a normal place of work, whether you have one or multiple normal places of work, would normally not be deductible. However, in this case, the ATO has kind of refined and updated its guidance and suggests that if you do have a coexisting work location, which is not near the place where you normally sleep at night, where your home is, your normal home is, then you can potentially claim a deduction for the travel to and from that location and also expenses incurred while staying overnight at that coexisting work location that is not near your normal home. So it is well worth taking a look at the ATO's updated guidance. It will simply confirm what you probably already know in some cases, so normal home to work travel, providing a bit of guidance and more examples around when that will and won't be deductible. Situations around fly in, fly out workers, again, it's something that has become more common over recent years, and the ATO fleshes out its guidance in that area to show us when things can and can't be deductible and the point at which things start being deductible for workers, but also the point at which things start becoming otherwise deductible for employers as well. So important for us all who deal with individual clients or employers who may be involved in providing travel or travel expenses to their employees to get our heads around this new guidance. As I say, you will find in some areas the ATO's approach is probably a little bit different to what you may have thought in the past, and it may well open up opportunities to claim deductions and minimise and reduce FBT exposures in situations where that may not have seemed possible or may have been higher risk in any case in the past. So have a look at the draft ruling. It's only in draft. We will expect it to be finalised at some time in the near future, but it is worth starting to understand where the ATO is heading with this new guidance and some of the new concepts that the ATO is starting to adopt in this area.
The foreign resident CGT withholding obligations came into effect on the 1st of July 2016. So, new set of rules which hopefully a lot of advisors are now aware of. We've had some changes that come into effect from the 1st of July 2017, and these have received royal assent. As you know, if the vendor is selling something to the purchaser has a requirement to withhold 10% unless they receive some documentation from the ATO which is provided by the vendor. That would include a certificate that they are an Australian tax resident, so they wouldn't be subject to these rules, or that there's a variation down in the withholding tax rate. Now, from the 1st of July 2017, the withholding tax rate has gone from 10% to 12.5%, and the threshold for the exemption for real property has gone from $2 million down to $750,000. So a lot of property that might be sold in the 2017 year could have been exempt from these rules, but in the 2018 year would not be. So it's more important than ever that the vendor obtain the documentation they require and provide it to the purchaser, otherwise they would have a very big cash flow issue that they would have to deal with when 12.5% of their sales price is withheld by the purchaser and remitted to the ATO. In addition, for the purchaser, there will be the obligation to make that payment to the ATO, so a lot more paperwork involved. Therefore, it's important that both parties to the transaction and their advisors are aware of these rules and ensure that there's enough time involved to apply for the documentation they need from the ATO and be able to provide that to the purchaser.
Now, the ATO has released some interesting guidance looking at the application of Division 7A to arrangements where you might not automatically think that Division 7A could apply. The guidance is TD 2017 D3, Draft Tax Determination. Basically what happens is when we're looking at Division 7A situations, we're looking primarily at where a private company has provided payments, loans, or has forgiven debts for the benefit of shareholders of the company or certain related parties, associates of those shareholders. But there is a provision within Division 7A that basically says that if a private company has made a payment or loan to another entity, and that could be another company, it could be a trust, for example, and then that entity has then provided a payment or loan to a shareholder or their associate of the first company, that can also be captured by Division 7A. Now, what this tax determination looks at is whether those rules could apply in the context of ordinary or normal commercial arrangements. So one example the ATO uses is where a private company pays a fully franked dividend to another company or another trust. That company or trust then provides a loan to a shareholder or their associate of the first company that paid the dividend. And the ATO says that these rules can capture that if a reasonable person would conclude that the payment of the dividend was part of an arrangement or a scheme to ultimately then provide that payment or loan to the ultimate recipient, the shareholder or the associate of the first company. So we do need to be quite careful. Division 7A can apply to those direct benefits that are provided by private companies. We've got some special rules that can apply where we've got unpaid distributions owed from trusts to corporate beneficiaries. But this also serves as a bit of a warning to look a bit more broadly at arrangements involving private companies, because there could be things that are captured that, again, on the face of it may not look like they fall within the normal scope of Division 7A. So it's worth having a look at if you deal with clients who have private companies. The ATO does provide a number of examples looking at situations where these rules could potentially apply, and it is worth getting your head around the sorts of things that could pose a risk when it comes to the application of Division 7A.
In previous tax roundups, we've actually covered off some specific guidance the ATO have given in relation to a group of employees who were working on a project on Curtis Island. And these employees seem to think that because they were getting a certain allowance, they were automatically able to claim a deduction. That's not the case, and the ATO are further going through the case with some of these employees, in particular with an AAT case, Hamilton and the Commissioner of Taxation. In this particular example, the employee thought that they would automatically be able to claim deductions for expenses that they had received allowances in relation to. Unfortunately, they weren't quite aware of all the rules and didn't have sufficient documentation to support their position, which resulted in them not winning the case. So there were tools, mobile phone expenses and overtime allowances which the employee had tried to claim deductions for. In relation to the tools, they were able to produce credit card statements which showed they had spent a certain amount of money in a hardware store, but they weren't able to produce any invoices saying what that money was spent on. So therefore they weren't able to get a deduction because they couldn't prove that they had incurred an expense in relation to tools that they were using for work-related purposes. In relation to mobile phone bills, they were just trying to claim a deduction for mobile phone expenses, but they weren't able to evidence how much of the mobile phone expenses related to their work-related use. So they did get a deduction in that, but it was limited to $50, which was a lot less than the amount they had originally tried to claim. In relation to the overtime meal expenses, they had relied on the commissioner's rate and said that they should be able to claim a deduction for that amount. However, their employer had actually paid them a much lower amount, and they didn't have any records to substantiate that they had actually spent that money on their meal expenses. So in that case, they had a far lower deduction than the amount that they wanted to claim. Overall, the key factor here was they did not have sufficient documentation to be able to evidence that they had incurred the expenses, and that had a huge impact on their ability to claim any deductions. An important reminder to get the paperwork right from the beginning.
And that's the tax roundup for this month. Remember, follow our Twitter feed and we will keep you up to date on legislation as it is introduced and passes through Parliament that is relevant to the profession and to your clients. But for members, the budget tracker on the member-only website will give you a summary of all the key areas and where that legislation is up to at any one point in time. But there is a huge amount of change coming through. If you don't want to keep your practice up to date and update all your standards, working papers, client letters, tax advice letters yourself, then give us a call on 1800 800 232 and Julie will show you exactly what Knowledge Hop membership can do for you. We look forward to speaking to you soon.